There's a number that's been declining steadily for months, and it's raising questions across precious metals markets. The COMEX, the Chicago Mercantile Exchange, its metals division and the dominant venue for silver futures trading in North America, has watched its registered silver inventory fall to levels that would have seemed impossible just a few years ago. In late January 2026, registered silver holdings at COMEX-approved warehouses dropped below 30 million ounces for the first time in over a decade, down from peaks that exceeded 180 million ounces back in 2015. That represents a decline of more than 83% from historical highs. For context, registered silver is the portion of COMEX warehouse inventory that has been designated as available to satisfy futures contract delivery obligations. It's the metal that stands ready to back the paper contracts traded on the exchange, and when that number falls, it raises fundamental questions about supply, demand, and the mechanics of commodities markets themselves. This isn't a story about conspiracy or imminent collapse. It's a story about structural shifts in global silver markets, the tension between physical metal and financial derivatives, and what happens when an exchange built on abundant inventory confronts the reality of declining stocks. The decline in registered silver at COMEX matters because it speaks to broader trends: industrial demand hitting record levels, investor appetite for physical metal surging, and a pricing mechanism increasingly disconnected from underlying supply fundamentals. Today, we're examining what's actually happening inside COMEX vaults, why registered inventory has fallen so dramatically, what risks this presents to market function, and whether the current trajectory is sustainable. This is the story of how the world's dominant silver futures exchange is navigating a structural inventory squeeze, and what that means for everyone from industrial buyers to retail investors. To understand what's happening, we first need to understand how COMEX warehouse inventory actually works. The exchange doesn't own the metal in its approved warehouses. Instead, it operates a network of licensed depositories, secured facilities operated by institutions like JP Morgan Chase, HSBC, and Brinks, where participants can store silver that may be used for futures contract settlement. COMEX inventory is divided into two categories: eligible and registered. Eligible silver is metal that meets COMEX specifications for quality and form, typically. The distinction matters because only registered inventory can be used to settle contracts when traders stand for delivery instead of rolling positions forward or closing them out with offsetting trades. When someone holds a COMEX silver futures contract to expiration and demands delivery, the exchange must source that metal from registered stocks. If registered inventory is insufficient, the exchange faces a serious operational problem. Historically, COMEX maintained substantial registered inventories as a buffer. In 2015, registered silver peaked at approximately 182 million ounces. At that time, the ratio between eligible and registered was relatively balanced, and the exchange had ample supply to handle typical delivery volumes. Most months saw between 1 million and 5 million ounces change hands in physical delivery. The system was stable, liquid, and rarely questioned. But starting in 2020, the dynamics began to shift. Registered inventory started declining steadily while eligible holdings remained more stable. By early 2022, registered stocks had fallen below 70 million ounces. By the end of 2023, they stood at roughly 45 million ounces. By December 2025, the number had dropped to approximately 32 million ounces. And in late January 2026, recent reports showed registered inventory dipping below 30 million ounces, a level not seen since the early 2010s. The question isn't whether the number is declining. The data confirms that clearly. The question is why, and whether the current trajectory poses systemic risks to COMEX's ability to function as a reliable pricing and settlement venue. The decline in registered COMEX silver isn't happening in a vacuum. It reflects a combination of supply constraints, changing participant behavior, and structural shifts in how silver moves through the global financial system. First, let's look at mine supply. Global silver production in 2025 reached approximately 843 million ounces, according to preliminary estimates from the Silver Institute. That's up modestly from 2024 levels, but production growth has been sluggish for years. Silver is primarily a byproduct of mining other metals. Roughly 70% of silver comes from copper, lead, and zinc operations. That means silver supply is largely driven by demand for base metals, not by silver prices alone. Even when silver rallies, miners can't simply ramp up dedicated silver production quickly. Recycling provides additional supply, but that too has limitations. In 2025, an estimated 170 million ounces of silver came from recycled sources, mostly from industrial scrap and old jewelry. Recycling responds to price, but there's a lag, and much of the industrial silver used in applications like photovoltaics and electronics isn't easily recoverable. On the other side of the equation, demand is surging. Industrial demand for silver reached record levels in 2025, driven overwhelmingly by the solar panel sector. Photovoltaic installations globally consumed approximately 230 million ounces of silver in 2025, up from around 140 million ounces in 2021. The energy transition is structurally bullish for silver because every solar panel requires silver paste for its conductive properties. As governments worldwide accelerate renewable energy deployment, industrial silver consumption continues climbing. Investment demand is also elevated. In 2024 and 2025, physical silver coin and bar demand from retail investors remained robust, particularly in the United States and Europe. The U.S. Mint sold over 30 million American Silver Eagles in 2024, and demand remained strong into 2025. Investors seeking inflation hedges, concerned about monetary policy or diversifying away from traditional equities, have turned to physical silver in meaningful volumes. When you combine constrained supply growth with rising industrial and investment demand, the result is tightness in the physical market. But why does that specifically drain COMEX registered stocks? The answer lies in arbitrage and incentives. When physical premiums in retail and wholesale markets rise above COMEX spot prices, participants have an incentive to take delivery from COMEX, pay the relatively lower futures price plus delivery costs, and then sell that metal into higher priced physical channels. This arbitrage drains registered inventory because metal flows out of COMEX warehouses toward end users willing to pay premiums. Additionally, some large participants have been converting registered silver to eligible status or withdrawing metal entirely. In several instances over the past 2 years, major depositories reported multi-million ounce withdrawals in single months. Some of this metal likely went to industrial consumers locking in supply, some went to private storage for large investors. But the net effect is the same. Registered inventory available for futures settlement declined sharply. There's also a strategic element. Some market observers believe that certain large holders have moved metal out of registered status deliberately, either to reduce their obligations to lend metal for futures settlement, or because they anticipate higher prices and want to hold physical outside the exchange system. Whether this reflects bearish sentiment on COMEX's pricing mechanism or simply prudent inventory management is open to interpretation, but the result is reduced registered stocks. Historically, the vast majority of COMEX futures contracts are closed out financially before expiration. Futures markets exist primarily for price discovery and hedging, not physical delivery. Typically, less than 5% of open interest in any given contract month results in actual metal changing hands. But that's been changing. Over the past 3 years, delivery volumes on COMEX silver futures have trended higher. In some months during 2024 and 2025, delivery totals exceeded 10 million ounces, double or triple the historical average. More participants are choosing to stand for delivery and take physical possession rather than simply rolling contracts forward or settling in cash. Why? Several factors are at play. First, the premium for physical silver over COMEX spot prices has widened. Retail silver coins and bars often trade at premiums of 4 to 7 per ounce over spot, and sometimes higher during periods of acute demand. Wholesale 1,000-ounce bars, closer to COMEX deliverable form, trade at smaller but still meaningful premiums. When those premiums are wide enough, taking delivery from COMEX becomes economically attractive even after accounting for storage, transportation, and financing costs. Second, distrust in paper markets has grown among certain investor segments. Some buyers prefer physical ownership, skeptical that financial derivatives will hold value in crisis scenarios or concerned about counterparty risk in the futures system. This preference has driven increased demand for metal withdrawn from exchange warehouses and held in private or allocated storage. Third, large industrial users have become more aggressive about securing physical supply. With silver critical to manufacturing processes, especially in electronics and solar panels, some companies are locking in inventory by taking delivery from COMEX rather than relying on spot market purchases. This behavior intensifies during periods when supply chains are strained or when future availability is uncertain. Finally, there's a feedback loop. As registered inventory declines, market participants begin to question whether COMEX can continue to facilitate delivery at posted prices. This concern drives even more traders to stand for delivery while they still can, further accelerating the drawdown. It's not panic, but it is rational behavior in response to tightening supply signals. The result is that COMEX registered silver is being pulled in multiple directions simultaneously. Industrial demand, investment demand, arbitrage flows, and precautionary inventory building are all contributing to outflows. So what happens if registered inventory continues to decline? At what point does COMEX face an operational crisis? In theory, as long as there's any registered silver available, the exchange can facilitate delivery. But in practice, market function deteriorates well before inventory reaches zero. Here's why. COMEX operates on the principle of fractional backing. At any given time, open interest in silver futures far exceeds the amount of registered metal available for delivery. As of late January 2026, open interest in COMEX silver futures stood at approximately 140,000 contracts. Each contract represents 5,000 ounces. That's a notional total of 700 million ounces of silver underlying outstanding futures positions. Registered inventory, as noted, is below 30 million ounces. That means the exchange has roughly 4% physical backing relative to open interest. This isn't necessarily a problem under normal conditions because most contracts settle financially. But if a significant percentage of contract holders simultaneously demanded delivery, COMEX couldn't fulfill those requests with existing registered stocks. This is where the concept of a delivery squeeze comes into play. A squeeze occurs when demand for physical delivery exceeds available registered inventory, forcing the exchange or its clearing members to scramble for additional metal. In a squeeze scenario, several outcomes are possible. First, metal could be transferred from eligible to registered status. COMEX warehouses still hold over 200 million ounces of eligible silver as of January 2026. If owners of that metal were willing to redesignate it as registered, the supply bottleneck could be alleviated. But there's no guarantee eligible holders will do so, especially if they expect prices to rise or prefer to keep their metal outside the delivery system. Second, prices could spike sharply to incentivize new supply. If COMEX silver futures prices rose enough relative to physical premiums elsewhere, arbitrage would reverse. Metal would flow back into COMEX warehouses as participants sought to capture the premium. This is the market's natural self-correcting mechanism. But the adjustment could be volatile, with significant price dislocations along the way. Third, the exchange could impose emergency measures. COMEX has the authority under its rules to declare force majeure, modify contract terms, or settle contracts in cash rather than physical delivery if extraordinary circumstances arise. Such actions are rare and would likely trigger legal challenges, loss of confidence in the exchange, and potential regulatory intervention. But they remain a backstop if the system faces imminent failure. Fourth, and most troubling, a prolonged inability to source delivery metal could fracture the pricing mechanism itself. If COMEX can't reliably settle contracts in physical metal, its futures prices lose credibility as a benchmark. Industrial buyers, investors, and other market participants would increasingly bypass COMEX in favor of over-the-counter physical transactions, alternative exchanges, or decentralized markets. The exchange's role as the dominant global venue for silver price discovery would erode. None of these outcomes is imminent as of January 2026, but the trajectory of declining registered inventory increases the probability that one or more of them could materialize in the months ahead. Not everyone views the decline in COMEX registered silver as a harbinger of systemic crisis. Several arguments suggest the situation, while noteworthy, may be manageable. First, eligible inventory remains substantial. With over 200 million ounces of eligible silver still in COMEX warehouses, the total pool of exchange-held metal is far from depleted. If delivery demand spikes, warehouse owners have strong financial incentives to convert eligible to registered and capture delivery premiums. The distinction between eligible and registered is largely administrative. Metal can move between categories relatively quickly if the price signal is compelling enough. Second, COMEX has faced inventory squeezes before and managed them without catastrophic failure. In 2011, during silver's rally to near $50 per ounce, registered inventory fell sharply and delivery volumes surged. The exchange handled the pressure, prices eventually stabilized, and inventory rebuilt over subsequent years. Historical precedent suggests that markets adapt, supply responds, and equilibrium is restored, even if the adjustment process involves volatility. Third, the global silver market is far larger than COMEX alone. Total above-ground silver inventories, including coins, bars, industrial stockpiles, and jewelry, are estimated in the billions of ounces. COMEX represents a fraction of that total. If prices rise enough, silver will emerge from other sources: private vaults, recycling channels, and international markets. COMEX doesn't need to hold the world's silver supply to function. It just needs enough to facilitate orderly settlement of contracts maturing in any given month. Fourth, the narrative of an unstoppable physical squeeze can become self-reinforcing in ways that distort market behavior. Speculative buying driven by fear of shortages can temporarily drain inventories and drive prices higher, but these moves often reverse when the anticipated crisis fails to materialize. Markets have a history of overcorrecting in both directions. The current decline in registered inventory may reflect temporary dislocations rather than a permanent structural shift. Fifth, technological and logistical improvements have made it easier to move metal globally. Silver can be shipped, refined, and recertified relatively quickly. If COMEX faced a genuine delivery crisis, metal from London, Zurich, or other global hubs could be redirected to New York within days or weeks. The market's ability to source supply has improved, reducing the risk of localized squeezes spiraling out of control. Finally, it's worth noting that some of the most alarmist predictions about COMEX silver have been circulating for years without materializing. Forecasts of imminent default, price explosions, or exchange collapse have repeatedly failed to come true. Skepticism toward dramatic squeeze narratives is warranted given this track record. These counterarguments don't dismiss the decline in registered inventory, but they suggest that the situation may be more manageable and less apocalyptic than some of the more extreme interpretations imply. As of late January 2026, several recent developments provide additional context for understanding COMEX silver dynamics. Futures prices have been relatively stable, trading in a range between $29 and $32 per ounce for the past several months. This suggests that, despite inventory declines, the market hasn't yet priced in acute delivery stress. If participants genuinely believed COMEX was on the verge of failing to deliver, prices would likely be significantly higher and more volatile. Physical premiums, however, remain elevated. Retail silver products continue to command premiums well above historical norms, and wholesale 1,000-ounce bar premiums, while smaller, are also above long-term averages. This indicates ongoing tightness in physical channels, even if futures prices haven't fully reflected that tightness yet. Open interest has been relatively stable, without the dramatic spikes that might indicate a speculative rush to corner the market or force a squeeze. This suggests orderly market conditions, at least for now. Meanwhile, exchange officials and clearing members have not issued public warnings or emergency notices regarding delivery capacity. COMEX continues to operate normally, processing deliveries each month without reported disruptions. In December 2025, roughly 4.2 million ounces of silver were delivered against expiring contracts, a significant volume, but one that registered inventory was able to accommodate. However, the trend remains clear. Month after month, registered inventory has declined. The rate of decline has not accelerated dramatically, but neither has it reversed. If current trends continue, registered stocks could fall below 20 million ounces by mid-2026 and below 10 million ounces by late 2026 or early 2027. At those levels, the margin for error narrows considerably. Market participants are watching several key indicators. The ratio of registered inventory to open interest is one. As this ratio falls, the risk of delivery stress increases. The spread between COMEX futures and physical premiums is another. Widening spreads indicate arbitrage opportunities and suggest that the futures market is underpricing physical scarcity. Delivery volumes relative to registered stocks is a third. If monthly deliveries begin to represent a significant percentage of total registered inventory, say 20% or more, the sustainability of the current system comes into question. For now, the situation is stable but fragile. The decline in registered inventory hasn't yet triggered a crisis, but it has moved the market closer to the edge of one. So, what does all this mean for the various participants in silver markets? For long-term investors in physical silver, the decline in COMEX registered inventory is broadly supportive of the bullish case. Tightening supply, rising industrial demand, and structural shifts toward physical ownership all point toward higher prices over time. However, investors should be cautious about timing and volatility. A delivery squeeze, if it occurs, could drive sharp price spikes followed by equally sharp corrections. Speculative excess can create opportunities but also significant risks, especially for those using leverage or derivatives. For industrial users of silver, electronics manufacturers, solar panel producers, and others, the decline in COMEX inventory is a signal to secure supply through long-term contracts, strategic stockpiling, or vertical integration with refiners and miners. Relying on spot market purchases becomes riskier as inventories tighten. Companies that proactively manage their silver exposure will be better positioned than those caught off guard by supply disruptions. For traders and speculators, the COMEX inventory situation presents both opportunities and dangers. Volatility is likely to increase as the market navigates this period of declining stocks. Those who correctly anticipate squeeze dynamics or supply responses can profit, but those who misread the signals or over-leverage their positions can suffer significant losses. Risk management becomes even more critical in a market where structural imbalances are building. For the exchange itself and for regulators, the situation demands careful monitoring. COMEX's credibility as a pricing and settlement venue depends on its ability to facilitate delivery without disruption. If the exchange is forced to invoke emergency measures, or if delivery failures occur, trust in the system will erode. Regulators at the commodity. Futures Trading Commission may need to assess whether position limits, margin requirements, or other rules require adjustment to prevent market manipulation or ensure orderly functioning. More broadly, the decline in COMEX registered silver raises questions about the sustainability of fractional reserve commodity markets. Futures exchanges operate on the assumption that most contracts will settle financially, allowing leverage and liquidity to coexist. But when physical demand surges and participants increasingly stand for delivery, that model is tested. If COMEX silver is the canary in the coal mine, Other commodity markets may face similar pressures as investor preferences shift toward physical assets and away from paper claims. The implications extend beyond silver alone. Gold, platinum, palladium, and even copper markets operate on similar principles. If confidence in exchange delivery mechanisms erodes in one metal, it could spread to others. The financial system's reliance on derivatives markets for price discovery and hedging makes this a concern not just for commodities traders, but for central banks, governments, and financial institutions globally. The story of COMEX registered silver is ultimately a story about scarcity, trust, and the mechanics of modern markets. For years, the exchange operated with abundant inventory, facilitating price discovery and settlement with minimal friction. But as supply growth stagnated, industrial demand surged, and investor preferences shifted toward physical ownership, the system's assumptions have been tested. Registered inventory has fallen from over 180 million ounces in 2015 to below 30 million ounces in early 2026, a decline of more than 83%. The trajectory is clear, the causes are identifiable, and the risks are real. Whether the current path leads to a disruptive squeeze, a managed adjustment, or a gradual rebalancing remains uncertain. What is certain is that COMEX silver is now operating with far less cushion than it once had. The margin for error has narrowed, the potential for volatility has increased, and the question of whether the exchange can continue to function as the dominant pricing venue for silver has moved from theoretical to immediate. For now, the market continues. Deliveries are processed, futures trade, and prices remain within a recognizable range. But the vaults are emptying, and the question everyone is asking is the same. How much longer can this continue? And what happens when the answer finally arrives? The data doesn't predict the future, but it does map the terrain. And right now, that terrain is shifting beneath the feet of the world's most important silver market. What comes next will depend on how participants respond to the signals, how supply adapts to demand, and whether the mechanisms that have governed commodities markets for decades can withstand the pressures of a world where physical assets are once again asserting their primacy over financial abstractions. This is not the end of the story, but it is a chapter that deserves close attention, because when the vaults run low, the markets pay attention, and when the markets pay attention, prices move. The only question is how far, how fast, and who will be prepared when they do.